Hello, and welcome to another episode of the Profit Minds podcast. I'm your host, Dr. Stephen Kirch, creator of the Profit Minds Growth System, a unique blend of profit growth, productivity acceleration, and building robust business process for scale. In every episode, I interview entrepreneurs and small business owners from around the world with a unique story to tell. You can find the show on YouTube, LinkedIn, Apple and Google Podcasts, Stitcher, Spotify, and more. Hi, everyone. Today, my guest is Steve Juetten, founder of Bridgegate Partners, a business exit coach. And today we'll be talking about the primary reasons that business owners fail to sell when they want to, and how to be proactive in fixing this for your business. Welcome, Steve.
Thank you, Steve. I appreciate being here. Looking forward to the conversation.
Yeah, so as you know, I ask this of all of my guests. Tell me your story. How did you get to be where you are?
Well, thank you, Steve. And like many people, my journey twists and turns, right? But I'll give you the short version. So I graduated with a master's degree in English and intended to go on and be a teacher, professor, and got waylaid by that by going into the business world. So I worked for a couple of national utility companies, and then I found my way into the consulting arena. And for 25 years, I was a consultant for HR and benefits firms. And I enjoyed that so much because I found out that I really loved business and I loved learning about the businesses. But then when our son was born some 26 years ago, I got tired of traveling all the time and started my own financial advisory business where I was a fee-only financial advisor. After I did that for a while, I decided that it was time to do something different and went from being a financial advisor to being now a business exit coach. I sold my business in 2022, and that was a great experience. And I helped another friend of mine sell his business. So between the two of them, I thought, hey, I could do this. I could coach other business owners on how to exit their business effectively and profitably. And ipso facto, here I am.
So talk to me a little bit about the challenge, right? Some statistics that I've read about people wanting to sell their business and being unsuccessful. It's, well north of 50%. People that want to sell can't. And I mean, I know I have my perspective, right? The biggest problem that I see is that the CEO, the owner, the business owner is way too involved in the day-to-day of the business. And first of all, that's not scalable. Right. But it's also not saleable. But I'm sure there are other reasons. Talk to us a little bit about that.
Sure. So the 5 reasons that businesses, small to medium-sized businesses, meaning those that are under 10 million in revenue, don't sell are, number one, an unrealistic expectation of the value of the business. People that are selling a business just don't see it the way a buyer sees it. So an owner sees it in all its glory, and a buyer sees all the warts. And as a result, we have this unrealistic expectation. The second reason businesses don't sell is that they have negligible earnings. And again, depending on the kind of buyer you're looking at, they really want the business to be successful. But most businesses are not set up to generate the kind of cash flow that are important. And to a buyer, cash flow is everything, right? The third reason, and this is one that is surprising, is business owners have horrible documentation. There's no other way to say it. Their financial records are terrible. If they're lucky, they may do an annual report once a year, a P&L statement and a balance sheet. But again, a buyer wants to see trends and wants to see the right kind of information. Most businesses are horrible at that. The fourth reason, and this is one you can probably speak to as well as I, most business owners are inflexible when they go to negotiate the terms of the deal. They say, I want to do it this way. And as an example, their expectation might be that they get cashed out. Well, most buyers don't want to do that. Most buyers want to do a partial cash out and then an earn out or a note or something else. But if the business owner is inflexible, that'll kill the deal. 50% of the deals that crater happen because at that stage, at the what's called the due diligence stage. And then lastly, most business sales fail because there isn't a good plan, and something will come up and they won't be the owner won't be prepared for it. So those are the 5 primary reasons that businesses fail when they're trying to sell.
No. So when should a business owner? It's one of the funny thing. All small business owners will exit their business. Right. This is something that everybody can agree on.
Right, one way or the other.
But of course, it's better if you plan for it. So when should a small business owner start thinking about this?
Well, the rule of thumb is 2 to 5 years. And why 2 to 5 years? Because it depends on how much fix up you have to do to the house before you try to sell it. And that's the analogy that I use for most of the small business owners that I talk to. Most people have sold a house, right? And
Yeah.
you have the realtor go through and tell you, don't put carpeting in the kids' room, but do fix up the master bath, or you really do need to fix the roof, or the electrical system needs improving, or whatever. Or either your house won't be sellable or it'll be sold at such a lower price. It's the same thing with a business. If the business owner doesn't have enough time to fix it up, and at a minimum, it's going to be a couple of years. I have rarely seen businesses that are ready to go right away. Now, there are some circumstances that we call SOS sales, which is we just got to get out. Either the business owner has a health problem, or maybe the family has a health problem, or maybe the business owner is just done. I can't do it anymore. And those are called SOS sales. And it's save our ship, okay?
Yes.
And in that case, the business owner needs to realize that they're going to trade off income or value for time. But normally 2 to 5 years before, if we're working with a client, we're going to sit down and start the process. And mostly it's because we need time to improve.
So is there a process that you use for this then?
Yes, and it's really, we call it a pretty simple 5-step process. And the first step is you need to set goals. And I'm not just talking about the sale price. I'm also talking about who's your ideal buyer, and what time frame, and what do you want to have happen to the employees or the contractors that you're working with. So setting those goals. Second is the assessment, which is, okay, let's walk through the house and see what needs to be fixed and what we can forget. So the first one is goals, second one is assess. And the third step is the improve part of it. And this is where somebody like you, and I'm going to throw this back to you in a minute, Steve, where somebody like you would work with them and fix it up. And from the perspective of the buyer, and that's the part many business owners forget, is they look at their business from their perspective, but it's really the perspective of the buyer that's important. So working with a business coach like you, the third step is to improve the business. And then the fourth step is network and our market, and usually that means networking. And then the last step is the actual sale process. So it's those 5 steps.
Yeah, and I'm guessing that most people come to you when they say, "Well, I'm ready to get out."
They do. And we always start with the 3 rules that I have, which is I will always tell you the truth. We're going to work in your best interests, and you need to be open to making changes. And I want them to know that I'm on their side. I'm not a broker. I'm not working for the buyer. I'm working for you. But I will always tell you the truth. And if my assessment early on says this isn't ready to go, I will tell you that. Or I will tell you it's ready to go, but you're going to do it at a high discount. And that's where a lot of that, the first reason businesses fail to sell comes in, is that many business owners don't want to hear that. They want to hear, oh, my business is worth 2x, 3x, 10x, whatever number they have in their mind. But I do them a disfavor if I don't tell them the truth.
Yeah, no, I really appreciate that. And so I'd like to dig in a little bit on the kinds of things that you see business owners needing to do to improve their business.
Sure. Well, you know this as well as I do, that you want a business that is sustainable, and you want a business with a track record. Now, you can't go back and change your track record, but a buyer is going to look at 3 years worth of financials. So one of the improvements is to make sure that the business is profitable and sustainable. And this is sometimes hard for people, but if the business owner is too much a part of the business, that's going to make it hard to sell. In other words, a buyer is going to look at it and say, if the owner walks away, what do I have left? And so that's where a lot of the development needs to happen, where we can start divorcing the owner from the business at that point and try to make it a sustainable business, and sustainable not in terms of will it go on. I've heard this referred to as the vacation rule, right? If the business owner goes on vacation for 2 weeks, does the business continue to run? And if it doesn't, then we have a lot of work to do. So that's one item. Another one is very simple. We need to get the books and the financial records in order. And you might be surprised at how poor, maybe you wouldn't be, how poor most business owners are in terms of understanding their own financials. And so depending on the kind of business it is, we want to know growth rates, we want to know sustainability, we want to know what the lifetime value of a client is. We want to know all of those details because that's what a buyer wants to know. For example, is one of your clients or customers, do they make up too large a proportion of your business? Because that's a huge risk, right? If you leave and that one client leaves or that one customer leaves, then the business is going to take a hit. So that part of it is to try to improve the business and make it profitable and make it sustainable without the owner.
Yeah, that's interesting because one of the platforms that I use for coaching my clients and helping them to scale the business is we have a set of KPIs, and one of the key performance indicators is exactly that, the concentration of revenue, and that the concentration of revenue should not be more than 20% in any one client. I don't know if your numbers agree with that, but that seems to be the sort of benchmark. If it's less than 20%, then it's okay, but if it's more than that, then it's a serious problem.
Yes, revenue diversification, we call that.
Yeah.
I'll tell you one real quick story. I was working with a consultant, and who I met through a mutual client, and very, very good business model and a very good coach. And then we were sitting down, and I said, just out of curiosity, how much does company X represent in your business? And he said, well, it's about 90%. And I was shocked. For obvious reasons.
Wow.
And then,
yeah.
Sadly, about 2 years later, that company got bought by another larger company, and he lost that business. And it was because he was sole practitioner, very good at what it is that he did, but he had lost that diversification value. I didn't work with him. It was just a fellow that I met and stayed in touch with, and sadly, several years later, he was struggling mightily.
Yeah. In fact, I had a client that came to me. In fact, he recognized that this was a problem, not specifically because this client was too big a fraction of his revenue, but because he got wind that this client was about to leave. And with the client making about 40% of his revenue, he said, I better do something about it. So we had about a year, maybe a little bit longer, between when I started with him and when that client actually left. So we were able to weather that storm, diversify his portfolio of clients, and he managed to get through it. Now, he did let one of his staff members go, but he really needed to let that staff member go anyway, so it was sort of a convenient excuse.
Yeah.
But we managed to get through it without actually, heavy layoffs or any of that, because we were able to proactively build his business around the rest of, build the portfolio around other clients. And it's a huge risk.
It is a risk, and that's a very good explanation of one of the items that we would want to look at if we were trying to do an exit readiness review, is the concentration. And again, going back to your earlier question, if there's too much concentration there, it's going to take, a couple years or so to diversify. Now, Client doesn't have to do that. They understand that. But you're going to get a lot less value from a buyer because of that, because the buyers recognize this. Most owners have never sold a business. Most buyers have bought multiple businesses. And so they know the red flags, or the yellow flags at least. And that would be one that would be waving there. They would just say, oh, this is caution, caution, caution. So it takes a couple of years, and I don't know how long it took in this person's case. Probably each one is different. But it takes a while to diversify. That's all there is to it.
Yeah. No, but it's crucial to look at it. The other thing that I find, and I don't know if you find this as well, and I love the vacation rule, because one of the things that I do with my clients, one of the first things that I do is I ask them to set up a KPI on how many weeks of vacation they'll take.
Yes.
Because that's, and we're not talking about this year. We're talking about, this is a 3-year target. We build out, where do you want to be in 3 years? And I challenge them to make that at least 4 weeks. And obviously it should be more than, 4. It shouldn't be 48 Fridays. Right. Or 40 Fridays,
that's
right?
gaming the system a little bit. That's
exactly. It needs to be some amount of contiguous time when you are disconnected from the company.
And totally agree. I think that's excellent. And one of the issues is going to be that will show the cracks in the foundation, won't it?
It absolutely does. But the other thing that I find is that when we do an assessment of, who's responsible for what in the company, I don't know if that's part of your assessment, but we call it an accountability chart or a responsibility chart. It's not an organizational chart, but it's a, functional accountability table. And I find so often the CEO or the business owner's name is in every one of those boxes. Or far too many.
Far too many. Sure.
Yeah.
I would agree. We do that kind of an accountability check, not at the depth that you do, but when we're doing an assessment of a business, we're doing the ready to exit review. We want to find that out, and we will get clues at it. And if in my intuition, my spidey sense goes off, we will certainly pursue that. And I'll just mention this. It depends on the way the business is set up, because some businesses operate with contractors and some businesses have employees, and a contractor is almost never responsible for anything, just so you know. It's because they're paid for doing a task. That's what it's for. And it's different for an employee. So that will give us a clue sometimes. And we do want to talk to the staff, to the employees if we can, to get a sense of that. But there's no mystery to this. Most business owners started a business, and they are the business far too often. And that makes it difficult for the business to be sold.
Yeah.
Now that's different. There's two types of buyers. There's financial buyers and there's strategic buyers. Okay, if, for example, we were looking at profit binds, we might determine that it's an ideal fit for a strategic buyer, somebody that's looking to put the business into their menu of businesses. That might be okay then. But if it's an income buyer, they definitely want to know the answer to the question of what happens when the boss is not around.
Right. Yeah, so talk a little bit about the psychology, because one of the things that you mentioned early on was the challenge of, not only is it a problem that they're not getting anywhere near what they want, but they also have, this idea of the terms that they need to have. And there's also an emotional letting go, I'm sure, of I'm selling my baby, right? at some level. So talk a little bit about the psychology of selling a business.
Excellent. So when I sold my business, the two biggest surprises that were the challenges for me was, one of them was the emotional roller coaster of selling a business that I had built, just like you suggested. The other challenge that was both a strategic challenge, a tactical challenge, and an emotional challenge. I'm trying to sell a business at the same time I was trying to run a business. But we'll talk about the first one. So the emotional roller coasters, right? First, you make a decision and you say, okay, I'm going to try to sell the business. I've decided I'm selling the business. And And most owners don't even get to the part of what do I do next, but that's one of them. But the roller coaster goes like this because, again, to use an analogy like a house, you're selling your business, your baby, the thing that you've grown and nurtured, and by and large, business owners are 24/7. You're never very far away from it, and you've put your heart and soul in it. And if you run a business for a long time, you know it very well, and it becomes part of your identity, which is not easy to separate yourself from. And so that was one of the things that surprised me. I have a business coach, and I remember specifically one day in March, and my business was supposed to sell on June 30th. One March day, we were scheduled for a call, and he said, without even asking, he said, "What's wrong?" I said, "Oh, this is so difficult, and I don't know where to go, and I'm depressed." And he said, "Okay, what do you do the rest of the day?" I said, "Well, I have some appointments." He said, "Well, cancel them or postpone them. I want you to get out of there and go do something that's fun for you, because boy, you sound like somebody that's not having any fun." And he was exactly right. I don't know that I was clinically depressed, but I was certainly weary from doing all that. And I had 9 people that were in my group, and I was responsible for them. And it was just that. And on the other hand, when we started to get offers for the business, I was up here, right?
Of course.
Because, oh my goodness, this is somebody's going to pay me for this. So it was that emotional roller coaster. And then I would think about, well, what's going to happen to my team? Susie and Don and John and Paul, and I felt bad for them. And then in my business, particularly any business that is a service business, and I was thinking of my clients, and it was like, oh my goodness, I'm abandoning them. Are they going to think badly of me? So you have all these ups and downs, and managing that is really a challenge. And if you're not prepared for it, it can really derail that whole process. And if I may, I would just suggest that anybody that ever thinks about selling their business, they're tending to think of the tactical part of it. What is it worth, and how do I fix it up, or whatever it is? But the emotional toll on you as the owner is extremely high.
Yeah, just thinking about that, and thinking about your team, thinking about this, it's the business that you built, but you've invested in the people, well, if you have any processes, right, in building and creating the intellectual property, and whatever that looks like, all of those things that are a part of you. So I really liked the part when you said at the very beginning, the whole putting together your goals, just begin with the end in mind, right? That's the Stephen Covey thing.
Right.
And really understanding not just the financial piece, which I'm guessing is the sort of the easy part. And this is what I want to get. This is what I should, because, my buddy had a company just like this, and he sold it for, this multiple on revenues, and therefore I should get this, right?
Right.
Or that, or he only got this much, but I know my business is worth a lot more than his, so I should get this much, right? that I'm sure that goes through, but the thought process around what's going to happen to my team, and how many of them are going to want to stay with the new owner, whoever that is, or how many are the owner really going to want to keep. Again, part of that depending upon what kind of what kind of investment it is for the buyer, right? Talk a little bit about that.
Sure, it's the relationships that are actually surprisingly difficult to terminate. Okay, and that's the part. And this is just me as a business owner. Okay, I invested in my relationships with my workers, my teammates. I hired them. I trained them. I had a young advisor that worked for me who knew nothing about it, and I had trained him in the way that I do things. And then the relationships with clients, because in many cases I had 15 or 20 years worth of time with those clients. And remember, as a financial advisor, you're helping them go through their life, right?
Right.
And some of them were getting ready to retire, and now all of a sudden I'm going to leave them in somebody else's charge when I know their full history and I know everything about it. It's the relationships that turned out to be the hardest part for me emotionally. And I needed to find a way to navigate it, because just like you said, every business owner is going to come to an end. And the way I rationalized it was saying to the clients, and to the teammates, look, it's got to end. This is non-negotiable at some point. And we have to
you may be maybe in a plain pine box, but you're going to exit.
we're going to exit. And I'd rather do it in a planful way, in a way that I can think about. And I'll just mention this, that my team ended up very well off. They all ended up where they wanted to go. One actually took it as an opportunity to retire. She was ready to go, so she took it as an opportunity. Another one actually ended up buying a third of the business. He was the young advisor, and we split the business so that he worked with the Gen Zs, and that was great for him. And so I was able to boost him out the door. So that we were able to find a way all the way through it. And to a client, I will say this: all of them said, "Well, yeah, we could see that it was coming," and several of them said, "Well, it's about time." But it was more of an issue for me than it was for them, which surprised me. And just getting over that mental part of it, and finding a way to message this in a way, because once you tell a customer or a client you're going to leave, what's their first question, Steve? What do you think their first question is? What does it mean to me?
Yeah.
Because they like you and they appreciate you, but their real interest is, what does this mean to me? And so we had prepared and had done a good job messaging that, figuring out what it meant to them. And that's what I always tell the clients that I have, the exit clients. When you start thinking about who's important to you, on the next column, write, what does this mean to them? That will help you approach that. You have to stop thinking about yourself and start thinking about three other entities, all the stakeholders: the buyer, the teammates, the customers, and clients. And that's what we call winning on the way out. If I can coach a business owner to think about other people, the other stakeholders, then they can create a winning on the way out kind of an approach. The buyers that fail are ones that never get beyond that myopic, what does this mean to me? So that's one of the reasons we're careful about the clients that we take. If in my initial assessment, I don't think they can bridge that, if they can't get out of the what does it mean to me only, then they're not going to be a good client, and their business is likely to fail as well.
Yeah, that's great. Yeah, I'm reminded, just very quick story, that when I was chief of staff to the folks, the three guys running the factory in Intel Santa Clara, and we got notice from the corporation that we were going to have to shut down the factory in 18 months, and that 800 people were going to lose their jobs. The announcement that we made, the first one that we made when we said, we're going to be closing the factory in 18 months. He said, our commitment to you as the employees is we will help every employee find a successful new beginning. And it's exactly along those lines. And by the way, our turnover went from high teens to around 5% for that 18 months. Our turnover dropped, even though everybody knew that their jobs were going away.
It's a wonderful story about the relationship you have with employees and how to strengthen it. They knew you cared. They knew you cared.
That's right. So Steve, very quickly, we need to wrap this up. Talk about, you have a special report that my listeners, our listeners here can get to.
Yes. So the report is called Business Exit Made Easy: The 5 Vital Steps to Selling. And all they need to go to simplebusinessexit.com.
Wow.
And what I would tell people is go get that and take steps within the next 48 hours. If you're at all thinking about selling your business, step 1 and step 2 you can do right away. And I always tell people, I'm very action oriented. Take action the first 48 hours. So get the report. Don't just let it sit. Take action within the 48 hours. And it will start to build momentum so that you can make movement towards your exit, if that's what's important to you. So simplebusinessexit.com.
Great. And if people want to get in touch with you beyond that, what's the best way for them to reach out?
Yeah, email steve@bridgegatepartners.com.
Great. I'll make sure all of that's in the notes.
Thank you. Good. You're good.
So, and that concludes our show. Thanks to my guest, Steve Juetten, the founder of Bridgegate Partners. I hope you learned something about how to sell a business, how to prepare for a sale. I know I did. Thanks for listening. You've been listening to the Profit Minds podcast. This is your host, Dr. Stephen Kirch. Please visit www.profitminds.net for other episodes or to contact me. Thank you for your positive feedback, comments, questions, and for sharing this show with others. Thanks for listening. Have a grateful day.